macro trigger behind all the positive numbers as well. Let me move on to the FMCG space, and again, Dabur reported earlier, but just want to talk to the management about what lies ahead. Mr. Sunil Duggal, CEO at Dabur India, we spoke to him a bit earlier. I started by asking him about the quantum of price hikes that they've taken across various categories, firstly in the quarter gone by.
Well, we've taken our prices by around 6% during the course of the year. Part of course, it is a follow-through of last year's pricing, and part of it is fresh pricing. This is a little bit more than what we had anticipated in the beginning of the year, but then inflation is much higher than what we had thought it would be, so which has necessitated a higher level of price increases than what we had thought. Going forward, the outlook is a little unclear whether we'll be able to sustain further price increases or whether they'll kind of level off at current levels. I think a lot will depend upon the inflation situation and the input costs, and we'll have to see how things go. But certainly the price increases will not be as severe as they were last year, even though they'll be a little bit higher than what we had thought.
Just talk a little bit, sir, about the inflationary pressures. A lot of FMCG players have responded by reducing grammage. What's been your strategy?
No, we don't believe in that. We've just cut back a little bit on consumer promotions, but we don't cut back on grammage. We don't believe that's long-term value to the customer. What we are doing is we are basically trying to re-engineer cost to the maximum possible extent, do smarter sourcing, hedge our input costs to whatever extent possible. But the inflation pressures continue to be there, and they are very high in certain pockets, like say raw honey or sugar, and somewhat muted in say edible oils. But overall the inflation level continues to be high.
Just moving on to another aspect of business, sir, the deadline for the new packaging norms is approaching. How prepared are you for this, and what would be the impact?
Well, we broadly support it. I think it'll bring a modicum of uniformity into the whole packaging setup. It doesn't affect Dabur much because it's largely confined to foods and soaps and detergents. And in foods, we really are present largely in beverages, where our pack sizes already were conforming to the norms. So I don't think for us there is any material impact. But I think as far as the customer is concerned, it'll bring some uniformity and some visibility in terms of comparative pricing, which is a welcome step.
Okay, let me get into segmental performance, sir. Underperformance on the hair oil side and the oral segment, that's been a bit of a concern, continues that way. When do you see it turning around?
Let's come to hair oils first. There are two buckets in which we categorize the hair oils. There's the coconut derivatives, and then there are the perfumed hair oils. The perfumed hair oils did extremely well. We did the growth of around 16%, and that's really the heart of our portfolio. There was some pressure on the coconut-based hair oils because the pricing disparity between brands, say Vatika, which are value-added coconut hair oils, and the plain vanilla coconut oils expanded to a very high level. And this always impacts volume. We've seen it in the past that when there is a low table in terms of coconut oil prices, our revenues get impacted. We see this to correct itself over the next few quarters, so I'm not worried. Structurally, there's no real impact as we see it. And we are pretty heartened as to the continued strong performance of the perfumed hair oils. To your second part, which is oral care, yes, there has been a little bit of underperformance in terms of tonnage amongst our discount brands, which is the Red Tooth Powder and one of our toothpastes. But the good thing is that the premium variants, which are high margin, have been growing actually well ahead of the industry. And that's where we make obviously most of our money from. So the profit picture in oral care looks much better, even though the top line does appear to be a little sluggish at this point in time.
When do you expect oral care to come back on track? The Babool brand has been impacted by the price hike, I believe.
I think the focus for brand Babool is to extract better profitability rather than to go in for just top line growth. It's obviously not a very high priced brand, so the margins have been under pressure, and we are looking at re-engineering the whole positioning of Babool, spinning off new variants which will be at higher prices and obviously at better margins. So there's a lot of work in progress in Babool, and I believe that within the next 6 months we would have the brand back on track and regain its growth momentum, as well as generate significant profitability.
Just moving on to the skincare segment, what's been the performance there? It's been growing steadily, but what's the outlook on volumes? There have been some new innovations, etc., in that particular part of the market.
I think there's been a lot of innovation around the FEM portfolio, and that's really been driven by innovation. Again, we have rebranded the Oxy part of our bleach portfolio as Oxy Life, and put in a new whole range of new products onto the ground. I think what's heartening here is that the higher margin as part of the FEM portfolio is growing the fastest, and that is generating substantial margin expansion as well as good top-line growth. There also has been new innovation in Gulabari, which is the other big skincare brand we have. We will be putting into place a range of winter skincare products in the next few weeks, and we believe that the momentum behind Gulabari is also very strong. So overall, the skincare portfolio is showing very good resilience, very good growth, as well as being a fairly high margin business.
The CSD segment saw a drop about 17% in the second quarter. Again, similar question, what's the prognosis, what's the turnaround time we're looking at there?
I think there would be a revival. I think the worst is behind us as far as CSD is concerned. The first two quarters obviously were pretty much damaging in terms of growth. There was substantial decline over the same numbers last year. But having said that, I think we're seeing revival of demand. The order book looks good. And while we may not see numbers which were like last year's, but I think there would be definitely growth coming in on a YOY basis in the next 2 quarters, as unlike what happened in the first two. So I think the CSD issue doesn't concern us very much. I think we are on top of it.
So net-net, sir, now that we run through most of the important segments, what's the volume growth guidance? Seems like a fairly wide range that you've given, 8 to 12%. Are you concerned that you may move towards the bottom end of that band?
Well, for this year, in fiscal 13, we would project a band of around 8 to 12%. I think that's a fair space to be in. We'll try to operate at the upper end of the band, but one can't say for certain depending upon the demand outlook. As far as pricing is concerned, I see a 5 to 10% increase of prices this year vis-a-vis last year by the end of this year. And again, we'll try to hold it to the lower end of this band, but it could be that price increases will be in the high single or low double digits also.
Just looking forward specifically to the festive season, what are the indications on the FMCG end there, and how does it bear down on the Q3 performance then?
True, I think the food margins have been under pressure throughout the year, entirely on account of the rupee depreciation. The top line, which was around 18% in the second quarter, a little bit muted by our standards, was on account, like I said, of shifting of the festive season from the second to the third. We will see a definitely strong revival happening in the third quarter. Growth should be very substantial, even as compared to the second quarter. And as far as the margins are concerned, yes, they would remain under some pressure. I don't see any dramatic revival in margins because the rupee, after a brief period of strengthening, has once again weakened. It's now hitting 54. So I think the margin pressures would remain. There is a limitation on how much we can take up the prices because fruit juices are already, we believe, quite high priced, and the headroom for any further price increase is fairly limited. So the food business will grow really on the back of strong volume delivery and reasonably high, but perhaps not as attractive as margins as what we enjoyed last year. But overall, the profit pool which we extract from the food business should be pretty good.
All right, God, that's the last question. Now, what's the outlook on ad spends? There's been a bit of pressure on ad spends because of the inflationary picture. Where does it go from here?
Yes, definitely as compared to last year. Last year we did pull back ad spend on the back of extremely high inflation, which caught us suddenly. This year we are a little bit more on top of inflation, and we are putting into place also a lot of innovation in terms of product renovation as well as new product delivery, all of them which are very demanding in terms of ad pros. So the advertisement spends this year would be definitely 150 to 200 basis points ahead of what they were last year. And we'll continue this path over the next 2 quarters.
All right, thanks so much, Mr. Duggal. Appreciate you joining us. That's Dabur flat today. Trias responded earlier, of course, to the earnings. Let me move away and take a quick break, come back on the other side with a quick take on the global markets.